I love it when people post interesting comments in my videos because then it brings about a conversation. In my previous video, I mentioned MasterCard and Visa and the struggle they currently face with regard to stablecoins. And Rahul here says, please cover more niches rather than only the very giant companies. eVTOLs like Archer and Joby. Space companies are just booming like crazy for space plus defense applications like Rocket Lab and ASTS. Newer data center companies like CoreWeave, Iron, Nebius. Covering these would be quite helpful as these have a lot of eyes. Now, I'll admit that I have heard of some of these companies. How did I hear about them? By going through Reddit and more specifically Wall Street Bets. Sometimes I go on that subreddit to have fun and see what types of crazy things people are doing. And these stocks are some of the names that keep coming back again and again these days. In this video, I'll be covering 6 of them and I'll go over what I like or don't like about each and whether I would invest or if I think it's a good investment. Spoiler alert, all of these companies have a few things in common. The first is that they're all unprofitable, very, very unprofitable. The second is that the stock price for these companies has been going bananas over the last few months. They're all up and to the right, which explains all the attention and all the eyes that these companies have on them. And obviously, the third point in common they all have is that they're very popular with the retail crowd. So especially if you go on YouTube or on Reddit, you'll see that these names are being talked about a lot. If you want me to do a similar review for any stock or company that you find interesting, just leave the names in the comment for this video. Without further ado, let's get right into it. Now, before I begin, I just want to remind everyone watching this that what I'm gonna be doing in this video are quick takes, not a full in detail, deep analysis of any of these companies. The first reason is that doing a deep analysis takes quite a long time and it's impossible to do that quickly for 6 companies. But the second and more important reason is that my time is valuable and I cannot spend too much time doing research on companies, especially when it only takes 10 minutes to figure out that I'm not interested in these companies. So that's a bit of a spoiler alert for you, but I just want to mention this before I get comments saying that I don't know anything about these companies and that I omitted very important facts and all that. Okay, back to Archer Aviation. Essentially, this company creates this aircraft. It fits 5 passengers and it can take off vertically. So unlike an airplane, more like a helicopter. Now, of course, this aircraft will have defense applications. It's going to be used by the army. But more interestingly, from a shareholder's perspective, is the air taxi business that they're trying to build. So yes, this aircraft will be available in urban areas and especially in cities that have lots of traffic. It's going to bring down the time of your commute from 90 minutes down to 20 minutes or something like that. Archer Aviation has some strong backers, some real capital behind it. The main company being Stellantis. If you haven't heard of Stellantis, they are an auto manufacturer. They have some very famous brands like Citroën, Jeep, Opel, Chrysler, and they're the big investors behind Archer Aviation. Stellantis has opened a plant for Archer. They've started taking them through the process, through all the regulations. As you can imagine, when you're creating an aircraft for an urban area, there's a ton of policies and regulations to get through. And the official launch to an urban area is supposed to happen later on in 2025 when Archer will supply the UAE with a few aircrafts. Now, like I said, Archer is going to be making money 3 different ways. The first is through defense, so army contracts. The second is through the air taxi network that I also mentioned. And the third way is by directly selling these aircraft to airline companies like United Airlines, another one being Ethiopian Airlines, and a few more. The real interesting part of this company is that it's pre-revenue. Now, automatically, you should see a giant red flag waving in your head. Pre-revenue, that's a term that we've heard before, especially if you were investing back in the 2021 craze. So yeah, Archer Aviation is another one of those, $0 in revenue throughout its entire history. As you can see, the revenue is zero, but the company is spending a lot, and the expenses just keep rising year after year after year. In the past year alone, they've burned through $500 million. The second company on the list is Joby Aviation. This one looks like Archer, and actually, it's pretty much exactly the same project, except that this time it's funded by Toyota instead of Stellantis. They have 5 aircrafts currently in circulation, and they just signed a 6-year deal with Dubai to be the exclusive taxi service of the area. There is one big difference between Joby and Archer, though, and that is that Joby actually has revenues. They are already selling very small contracts to the US Army, and so they do have some revenues coming in. But those revenues are extremely small. That's 111,000 in the last 12 months. I'm sure some of you watching this video will make more in a year than this company does. And then we look at the expenses and it's 614 million. So just like Archer, this company is burning through cash. The expenses just keep increasing year after year after year. At the same time, yes, Toyota is funding this, and we can see it in the shares that are ballooning. They're just exploding from 585, 647, and now 721 million. So once again, to me, this looks like an R&D project for Toyota specifically. All these car companies are looking to the future, and they're trying to see if flying cars are the next way to go. But when we actually make a summary of these companies on the financial side, we get low revenues or no revenues, no cash flows, negative cash flows, share count that's increasing, so you're being diluted as a shareholder. We have debt that's accumulating on the balance sheet versus zero cash flows, by the way. Both companies are burning through their balance sheets, all the cash that's been injected by other companies and by the shareholders during the IPO. And at the end of the day, these are very complex industries whenever it comes to aviation and flying machines. So regulation is an incredibly important part of these stories as well. And as we all know, it's very hard to predict regulation. Lots of things can go wrong. When you're flying 5 people a kilometer above ground level, you have to make sure that your aircraft is not going to crash. And what happens if it does? That's probably the end of your company, especially if you have only 5 aircrafts in circulation. So to me, both of these companies are pure speculation. Go have fun if you want, buy those shares, but you're not investing, you're speculating. The other thing to note here is that time is not your friend. You're actually competing against the clock. One of the best parts of investing is that time is your friend. The longer you hold on to a company, the more time it has to compound its cash flows over time. We've all seen the snowball effect. Warren Buffett, most of his wealth comes from after he was 65 years old. In this case, when it comes to Joby and when it comes to Archer Aviation, the clock is against you. Because every quarter, every year, these companies are burning cash in order to make this project become a reality. If there's any hiccup along the road, either your companies are going to go bankrupt or the big investors are going to have to step in and dilute the hell out of you. So yeah, you're living on a prayer. You're not living on cash flows. And me as an investor, I like to live on cash flows. This is what I invest in. I invest in profitable companies that have steady and predictable cash flows. That's what I want to build. I want to build a steady cash flow stream that I can use in my personal life or to fund further investments. If I took both of these companies through the rated A quality framework, without a doubt, both of them would be Fs. Of course, the upside is huge, but the downside is also huge. That's not a good position to be in if you're trying to stay in the game for as long as possible. You're not a venture capitalist. Your goal is not to find 100 archers and maybe one will stay alive and create so much profit for you that it'll, compensate for all the ones that went to zero. You're not a venture capitalist. You don't have access to all these venture opportunities. As a matter of fact, the venture capitalists are the ones selling you these types of companies. That's why they go IPO in the first place. When you buy Joby Aviation at this price, you're paying an 8 billion market cap for a company that basically has zero in revenue. There are other companies out there that have market caps of 8 billion, so same price as Joby, but that are making 2 billion, 1 billion in free cash flow. That's the point of value investing. Like Rahul said in his comments on my YouTube video, there are lots of eyes on these companies. And the reason why is very simple. It's because the stock price is doing really well. Joby is up 104% over the past year. Meanwhile, Archer Aviation is up 168% over the past year. I know, the world of investing has changed. It's become democratized. That's a really good thing. On the other hand, anybody with a voice can talk about stocks and investments, and everyone has a different investment style. And so it's easy to get lost in all the noise and all the information that's out there. What's good, what's not good, what's worth buying, and what's worth selling. These are all very important questions that we all have as investors. I used to be one of those. That's exactly why I created this tool called Rated A. I'm a long-term value investor. I look for value. I look for cash flow when I invest. It just happens that a lot of these companies that produce a lot of cash flow also pay dividends. So I'm making a list of all the dividend paying companies in the world, and I'm giving them a few ratings: quality rating, a value rating, and an income rating. And the entire purpose is to get an easily digestible signal whenever a high quality company starts trading at a fair price. That's what I do. I've read many books on investing. I've been in the game for many years, and this is the best way to invest. Find high quality stocks, don't overpay, and just hold them for the long term. Read Warren Buffett's books, read Terry Smith's books. All of these legendary investors, they all say the same thing. I use these ratings for my own personal investments. I use these ratings for the company's investments. And if you want to check them out and maybe use them for your own investments, the platform is free for 2 weeks. There's zero risk. You can cancel anytime. Try it out. Next up on the list, I've got Rocket Labs USA. Can you guess why everyone in the retail investment world has their eyes on this company? That's right. It's the 670% rise in the stock price in the past year. Rocket Labs is a full space vertical company. They launch rockets and then they create materials for all the machinery that goes into space. So solar panels, satellites, all of that good stuff. It's very sexy. It's a very sexy company, very innovative, but it's competing with the likes of SpaceX. Very well capitalized, backed by the richest man in the world. So for now, it's too early, way too early to say who will win in this industry. Revenues are increasing pretty quickly. I like to see that. However, yes, they are losing more money every single year. And of course, they're also diluting every single year. And that's fine. That might actually be a smart move, especially when the stock price looks like this. As long as there are suckers to buy your really expensive share, that's really cheap capital to be raising. Crazy enough, but that's about it for this company. They have a few new models of rockets coming out, but to me, this is pure speculation. This company has a market cap of 16 billion on revenues that are at less than half a billion and negative cash flows. Think about that. What other company could we buy for 15 to 16 billion? Well, for example, one that I've been buying personally in the company account is Evolution. Think about this. These two companies are worth the same amount. As soon as you buy Evolution, you will be making $1.1 billion of free cash flows. This is actually in euros, so it would be 1.2 or $1.3 billion in free cash flows. As soon as you buy Rocket Labs, you're losing 200 million in free cash flow every year. I just don't understand it. I don't understand why someone would buy Rocket Labs if not for speculation or momentum trading. Anyone who's focused on fundamentals would not touch this company with a 10-foot pole. But it is very exciting. It looks really cool. It's beautiful. It's sexy. It's really cool. It's cool to be a part of this. We can all agree on that. Moving on to the next company here, we have AST SpaceMobile. That's another high-flying stock at the moment, up 310% over the past year. 15 billion market cap, remember that. This company is building the first and only space-based cellular broadband network. That means that they're trying to connect your phone to 4G and 5G, especially in the areas of the world where you don't get coverage. According to them, that's 90% of the Earth's surface, and this would obviously take into account all the oceans and the deserts and the jungles, anywhere that the traditional networks like AT&T, Verizon, or Vodafone don't really cover. So it's actually really cool. They're going to send these giant satellites into space. And at the same time, they're building a whole network of structures on Earth, on land, where the traditional networks like AT&T and Verizon will be able to connect on demand and access the satellites as if they were a tower network. Roaming tower, I should say. Leading mobile network operators as investors, partners, and customers. So they've got the entire suite of all the mobile network operators around the world. I see Canada, the US, the UK. No matter what country you are in, all these operators are investing heavily into this project. And also, in the future, they'll become the main customers. I keep saying in the future because this is another company that's pre-revenue. So it's not making any money at the moment. All the mobile network operators are currently pouring money into it in order to build this out. This type of very big, very ambitious infrastructure project kind of reminds me of many infrastructure projects that have been funded by the public and ended up being horrible failures in the past. If you're from the United States and you were investing back in the 2000 dot-com bubble, you'll remember a company called Global Crossing. This company was worth $47 billion at its peak, and a few years later, in 2002, it went completely bankrupt. This company was in charge of building undersea cables that would connect the North America and Europe, if I'm not mistaken, and it was very ambitious. It would have been a unique asset. It would have brought in a lot of cash flow, but the debt and the weight of the bubble just ended up costing investors a lot. All that being said, ASTS is now burning through its cash reserves, losing 250 million in the previous 12 months. And this company is another one that's fighting against the clock. They're expecting revenues to start coming in 2026. If there is any hiccup along the road, that could be the end of the investors in AST SpaceMobile. These types of companies have binary outcomes that are reminiscent of the biotechnology industry. A very specific type of adrenaline junkie investor loves biotechnology because you invest your money, then there's an outcome, which is binary by the FDA. Either the drug passes or it doesn't. If it passes, then the stock price can just explode to the upside. A lot of the times, though, that does not happen, and you end up losing your money. And often those stocks go to zero. So if you're into a binary outcome, then maybe AST SpaceMobile is a company for you to be interested in. Once again, for me, no revenues, no cash flows, race against the clock, 15 billion market cap. What more do I need to say? The final company I'm covering here today is called CoreWeave. I know I said I was going to do 6, but I looked at the 6th and it was just going to be more of the same. So we're just going to be focusing on CoreWeave. This company's business model is rather simple. It builds data centers, it loads them out with GPUs, and then it rents out the space to whoever wants to buy it. So it's like a third-party data center that's not controlled by one of the big 3 or 4, which are Microsoft, Amazon, Alphabet or Google, and Oracle. In a way, it's the 5th hyperscaler, and it's a neutral one. The other 4 are renting out the space, but they're also using it for themselves. So there's a conflict of interest. This one is entirely conflict of interest free. And if you think, whoa, this is great for a company like NVIDIA, all the other hyperscalers are trying to find solutions to cut NVIDIA out of the supply chain, trying to find chips to replace NVIDIA's GPUs. Well, you're onto something because NVIDIA is the company behind CoreWeave. NVIDIA provides CoreWeave with first access to all of its GPUs and also owns about 10% of this company. As you already know, AI demand is insane right now, and so this company is diving in headfirst and investing massively into opening these data centers, spending $8.3 billion in the trailing 12 months. So, this is what scares me about this company. The first is its relationship to NVIDIA. It's basically an arm of NVIDIA. If NVIDIA decides to crush it one day, it absolutely can. If NVIDIA decides to not give it priority access to its GPUs anymore, it can do that quite easily, and that would probably be the end of CoreWeave. So if all that's the case, why not just invest in NVIDIA since they have a stake in CoreWeave? And CoreWeave is a lot more expensive on a per share basis. So on top of the fact that CoreWeave only exists because NVIDIA wants it to exist, the second thing that scares me about CoreWeave is the financials. Like I said, this company is investing $8 billion in free cash flow in the last year. It's also taking on quite a lot of debt. That's $10 billion in debt. It makes sense. Building data centers is not cheap. It's very capital intensive. The theory is that once everything is built out, then it's going to be much less expensive and the passive cash flows will start coming in. But like everything in investing, the future is unknown. And so there's no guarantee that those profits will flow in the future. Yes, this is absolutely an exciting company, partly because it's up almost 300% in the last 4 months, but also because owning data centers, data centers are a critical piece of infrastructure, especially when it comes to AI and the future of technology. But just keep in mind that you're paying $75 billion to own this company. Investing is not just about what can happen in the future, it's also about opportunity cost. What else could you buy today with that money instead of buying CoreWeave? We all know this company, it has a great moat, it has a great brand. They've been around for 100 years, they're probably still going to be around in the next 100 years. And this is a company that's worth $35 billion, so roughly half of what CoreWeave is worth. The difference is that Hershey's is bringing almost $2 billion in free cash flow a year and also pays a 3% dividend yield. CoreWeave is currently losing 4 times as much as Hershey is making, and it's worth twice as much. Now we get to the important part of this video, and we're going to be talking about these two gentlemen here, Warren Buffett and Charlie Munger, two of the best investors that ever lived. When it comes to the 5 stocks that I mentioned in this video, these two guys would never in their lifetime invest in a company like that. People love to bring up quotes by Warren Buffett and Charlie Munger whenever it fits their narrative, but there's 4 or 5 things that they've said that goes completely against investing the companies that I've mentioned in this video. The first, stay away from sexy industries, sexy companies, the ones that everyone's running into. The second, growing industries don't always create value for shareholders. Think of the automakers and think of the aviation industry. The third is look at a company's financials. Learn what you are buying. Project out what you can expect to earn and always try to clear 1-foot hurdles, not 3-meter hurdles. Give yourself the chance to succeed. The fourth thing, if a company depends on one other company for its existence, stay away from that. That's a huge risk. If a company has only one investor or only one customer, then there's a chance that your investment could go wrong. The fifth thing is that IPOs tend to perform poorly. And all 5 of the companies that I talked about in this video have IPO'd in the previous 2, 3, 4 years. What's an IPO? An IPO is the VC firm or the private equity firm that owned the company before trying to dump their shares on the public for as much as they can. Either that or they're trying to raise cheap capital that they don't want to put in by giving some ownership to retail investors. And these guys are very intelligent. They will only do this at the peak of the market hype when they can get the most money for the piece of crap that they're trying to sell. These are all things, core tenets of these two gentlemen's philosophy when it comes to investing. Yet, everyone seems to forget them when it comes to stocks that see their price double or triple in the matter of a few months. greed takes over. So, based on everything I've said, I would avoid all of the companies, and I would recommend that you do too. Unless you have a specific edge because you work in one of these industries, or you have one of these companies as your client, you have some specific knowledge, or you're a different type of investor, and that's completely fine too. Maybe you're a trader, maybe you're a momentum trader, maybe you're a technical trader and you look at charts. All that is fine. I'm just not one of those. I'm a fundamental long term value investor. I look at how much cash flow the company is generating and if it's worth paying for today. That's it. The companies I buy are high quality and high cash flowing companies that are selling for a fair price. Yes, it's really boring, but it also makes me money. And remember, investing is not supposed to be fun. It is supposed to be like watching paint dry. Every good investor says this. Every good, established long term investor says this. These are the people that have been in the game for 40, 50 years, that have the best track records over the longest time periods. If you are on the edge of your seat, full of adrenaline, waiting for the quarterly report to drop every 3 months, you are not a long term investor. I'm going to leave it at that. Have a good one, and I'll see you in the next video.